How do you calculate standard deviation? Have you ever wondered how traders predict stock price movements? One key tool they use is standard deviation. So, how do you calculate it? Let's break it down step by step. First, you need to find the mean or average price of the stock over a specific period. To do this, sum all the prices and divide by the number of observations. This gives you a central point to work from. Next, calculate the deviations. This means subtracting the mean from each price to see how for each price is from the average. These deviations show you the spread of the data. After that, square each deviation. Squaring ensures that all values are positive and gives more weight to larger deviations. This step is essential for understanding the overall volatility. Now, average those squared deviations. You can do this by summing them up and dividing by the number of observations -1 if you are calculating a sample standard deviation. If you are looking at the entire population, divide by the total number of observations. Finally, take the square root of that average. This final step gives you the standard deviation, which tells you how much the stock prices vary from the mean. In stock trading and options, standard deviation is a vital measure of volatility. A high standard deviation indicates that prices are likely to fluctuate widely, while a low standard deviation suggests they will stay closer to the average. Now, let's connect this to implied volatility. Implied volatility is derived from options prices and can help you estimate the one standard deviation range of a stock's potential price movement. For example, if a stock has an implied volatility of 20%, the one standard deviation range might be plus or minus 20% of its current price. This range helps traders gauge the likelihood of price movements. Understanding probabilities related to standard deviations is also important. About 68% of price movements are expected to fall within one standard deviation of the mean. About 95% will fall within two standard deviations, and about 99.7% will fall within 3 standard deviations. This knowledge helps traders assess the likelihood of extreme price movements and manage their risks accordingly. By applying standard deviation calculations to both historical data and implied volatility, traders can better analyze market conditions. This understanding can lead to more informed trading decisions in the stock and options markets. So, the next time you look at stock prices, remember how standard deviation plays a role in predicting price movements.